A viewer left this comment on my NVIDIA video. They said it should be mentioned that you're setting aside $29,000 to put on this trade. And while using margin will reduce that to only a fraction, I wanted to set up the same structure built for a small account for a fraction of the capital. I've traded options full time for over a decade, and I want to show you how to use your capital the most efficiently, what the small account version of this trade is, and the exact way that I would set it up. Because my job is simple: win when you're right, win when you're wrong, never gamble at any account size. Let me show you the trade he's talking about, because the number only makes sense once you see it. On NVIDIA, I bought the 220 call and sold the 245 call. That's a call debit spread, and it's worth up to $2,500 if NVIDIA runs higher. To pay for it, I sold 2 put options at a 145 strike price. That's the whole trade. A naked put is a real promise. If the stock drops to your strike, you buy the shares, period. Your broker holds buying power in reserves so you can keep that promise. That's the $29,000 the commenter computed. Now remember, this is on a cash basis. In that trade, we sold 2 of the 145 puts. So if you're not using margin, then your broker will reserve $29,000. If you're using margin, then your broker is going to reserve less than $6,000. Even so, I'll show you how to set this up for a smaller account, because you want to make sure that you use your capital as efficiently as possible. It's your own money. You don't want to park it as collateral while the trade is open. What that capital buys you: the biggest credits. Naked puts pay the most premium. It's also the cleanest win. Assignment means owning a great company at your chosen discount. For example, owning NVIDIA at $145 would be an incredible gift, considering that many people bought NVIDIA over $200. If you have the capital and want the shares, then utilizing the finance bull and selling the naked put, in my opinion, is the best way to execute upon the trade. This video will help a lot of people who have smaller accounts, because it'll allow you to be more capital efficient when setting up your trades. The small account version changes one thing: you'll buy a long dated put option. The put side becomes a defined risk spread, whereas things like the call spread and winning this trade in 3 directions stays the same. All you're doing is adding 1 extra leg, and you'll be able to dramatically increase your buying power efficiency. And here's the part most people miss when they hear smaller version or smaller account. You are not giving up your upside. The call spread doesn't change at all. That $2,500 of potential profit is exactly the same, and that's only per contract. If you do 10 of these, then that's $25,000 of potential profit. The only thing that changes is how much buying power the put side ties up. What happens to your buying power? Naked put, when using a cash account, you buy 100 shares at the strike price. The broker reserves the capital for the whole entire promise, roughly $20,000 to $30,000 on a mega cap stock. When using a put spread, your max loss is going to be the width of the strikes less the credit you receive for putting on that trade. Your buying power reduction is going to equal that width less your credit. A $10 wide spread risks $1,000, not $29,000. You choose the width. The width sets the risk, and the risk will fit your account. Quick, don't go anywhere. In about 90 seconds, the complete small account blueprint, every step in order with the numbers. But first, the honest part nobody tells you: what the small version gives up, because it's not free. The smaller version gives you a smaller credit. The protective put you buy costs money, so you're paid less money to enter. Also, a capped down outcome. Below your long put, while the losses stop, so does your clean own it at a discount win, meaning that if the stock drops below your lower price put option, then you're not going to be able to take ownership of that stock. The same discipline is required. A defined risk spread on a company you don't want is still gambling for premium. In this situation, you're trading premium for protection. That's a fair trade at the right size. Here's the scale of the difference. Full version: you sell a naked put on a $360 mega cap. Broker reserves roughly $25,000 to $29,000 of buying power. For a small account, you sell that put plus you buy one $10 lower. Your max risk and your buying power reduction is about $1,000. Wider spread equals more credit and more risk. Narrower equals cheaper, safer. but less credit that you'll receive when putting on the trade. You can choose the best width in order to fit your account. The sizing rule that keeps you alive. Size by the max loss. Never buy it's cheap. Keep any single trade's max loss to a small single-digit percentage of your account. One position at a time until the structure is second nature. The goal at a small account size isn't getting rich this month. It's building the skill and the track record that compounds. Survive first, compound second. The number one small account mistake. Because spreads are cheap, beginners sell 5 of them and quietly rebuild the same $29,000 of risk they were avoiding. Cheap per trade is not the same as safe in total. Quantity creep is how small accounts blow up. One right-sized spread on a company you'd love to own beats 5 lottery tickets every single time. And while the structure protects you, only discipline protects you from yourself. Who's telling you this? Real verified accounts. Below you can see our recent performance. This was built with the same structure that you just learned, sized up over a decade, not overnight. Every statement I show is real. That's the whole point of this channel. And you can also see that we outperformed during market pullbacks. In March 2026, when the market was down around 8%, we were down less than 1%. The real lesson, the finance bull isn't a rich person trade. It's a structure, and structures scale down. Define the put side, size by the maximum loss, pick companies you'd love to own. Win when you're right, win when you're wrong. Never gamble. Here's the small account blueprint with the exact strikes, exactly what I promised. You'd pick a mega cap you'd love to own. So in this case, with NVIDIA, we bought the 220 call, we sold the 245 call. That gave us $2,500 of potential upside if NVIDIA rips higher. To finance that, we sold 2 of the 145 put options. That's where he got the $29,000 of buying power. If you're using a margin account, it uses up a little bit less than $6,000 of buying power. So in this situation, I would keep the call strikes the same. For the put side, I would sell the 165 and I would buy the 135. That reduces it to a maximum loss of $3,000. And therefore, if you're using a cash account instead of $29,000 for 2 naked puts, this trade would use up $6,000 of buying power. The reason why I'm increasing the strike price to 165 is I want to collect more premium in order to help me pay for the 135 put options that I'm buying. That's the blueprint. Same structure, sized for your account. And to the viewer who left that $29,000 comment, thank you. Keep the comments coming. The honest comments make the best videos. Who's telling you this? I'm a former Wall Street investment banker. I worked at Morgan Stanley, CIBC, and Petsky Prunier. Do you want the exact trades I send my members in real time? The 14-day trial link is in the description. And tell me in the comments, what's your account size range? And which stock should I run the small account version on? Your answer could be the next video. Win when you're right, win when you're wrong. Never gamble. And if you want to see the original NVIDIA trade this whole video came from, the exact strikes, the real orders, it's on the screen right now. Click it. That's the video YouTube thinks is the most valuable to you right now.